Inflation just came in lower than expected. Core inflation is sitting at its lowest level in years, and your mortgage rate still went up. Most people assume those two things move together. Inflation goes up, rates go up. Inflation cools up, rates should ease. That's the whole model. But for fixed rates, that's not how it works. Fixed rates aren't set by the inflation report, and they're not set by the Bank of Canada. They're set by bond market. And right now, the bond market isn't reacting to inflation at all. It's reacting to something else entirely. I watch bond yields and lender pricing daily because that's how I know when to tell a client to lock a rate versus wait. So let me show you exactly what's actually moving your rate right now, what that means if you're trying to decide between fixed and variable, and what I'd actually be watching if I were you. Canada's June inflation came in at 2.8%, down from 3.2 the month before and lower than expected. The Bank of Canada's own preferred core measures, the ones that strip out food and gas, dropped even further to their lowest level in years. On paper, that's exactly the kind of report that should keep rates calm, maybe even easing. The Bank of Canada agreed. It held its rate on July 15th unchanged. But over the same stretch, the 5-year fixed rates went up anyway, somewhere between 10 and 25 basis points, depending on whether the mortgage is insured, insurable, or conventional. Now, that's a real money on a renewal or a new purchase, and it makes a significant difference, moving in opposite direction of what the headline would suggest. And here's why. Fixed mortgage rates are not priced off the inflation report, and they're not priced off the Bank of Canada decision either. They're priced off the yields on the 5-year Government of Canada bonds. And that yield has almost nothing to do with what's happening domestically right now. It's reacting to conflict in the Middle East, Iran, and what's it doing to oil prices. Investors lending the government money for 5 years are pricing in the risk that oil-driven costs could show up in inflation down the road, even if they haven't yet. The fear is pushing up the yields and your fixed rate, regardless of what last month's inflation report actually said. So if the inflation report didn't do this, and the Bank of Canada didn't do this, what does that actually mean if you are sitting there right now trying to decide between locking in a fixed rate or going variable? Right now, fixed and variable rates are being driven by two completely different things. Variable is tied to the Bank of Canada's overnight rate, and the bank just held with an inflation picture that gives them every reason to keep holding for a while. Fixed is tied to bond yields, which are currently being pushed around by a geopolitical situation that has nothing to do with Canadian inflation and is genuinely hard for anyone to predict. No guru, no market guru can predict that. That means the usual logic that rates are probably going to keep easing, so go variable and write it down is not as it normally is. Variable might actually be the more predictable side right now, precisely because it's anchored to domestic inflation picture that is more stable. Fixed is the side with the real wild card attached to it because that also depends on down south. So this is the part that gets lost when people just see a headline that say rate went up or rates went down. Fixed and variable can be telling you two different stories at the same time, and they are right now. So if you can't just wait for things to calm down to know which way this goes, because nobody knows how long that plays out, what do you actually do with this? That is exactly the situation where a rate hold is built for. Most lenders will guarantee today's rate for 90 to 120 days while you shop or finalize a purchase, even if rates move up in the meantime. But very few people knew this and use it strategically. If you've got a renewal coming up in the next few months, or you're mid-shop for a purchase, locking a hold now protects you from exactly this kind of move without committing you to anything if rates happen to go down. And because fixed pricing right now depends on lender, insurance category, and timing, the best rate isn't one number. The best insured 5-year fixed available through the right channel is still meaningfully lower than what a bank's own website shows you, even after this increase. That gap between what moves the headline and what actually applies to your specific file is the whole reason just wait and see is usually a wrong strategy, and especially in a week like this one. So here's the actual picture. Inflation came in soft, the Bank of Canada held, and your fixed rate still went up because it was never about the inflation report in the first place. It's about bond yields reacting to an oil shock nobody can time. Fixed and variable are answering to two different things right now, which changes how that decision should actually be made. And whether you're renewing, buying, or just watching from the sidelines, a rate hold is the one tool that protects you from this kind of move without costing you anything to use. If you want to know what a hold looks like on your specific file, or which side of fixed versus variable actually makes sense for your situation right now, that's a quick conversation, not a guess. I have included a link in the description. And if this helped make sense of a confusing few weeks of headlines, hit subscribe. I'll keep tracking this as the situation develops. This is Raghav from 7 Lending. See you on the next one.